If we've entered into a long-term contract, the issue becomes, when do we recognize the gross profit on that contract? If the terms are very clear in the contract, if the buyer can be expected to satisfy all his obligations, and if we can be expected to comply with all our obligations, we're almost certainly going to use what's called the percentage of completion method. If, however, we generally have a bunch of short-term contracts and there's some uncertainty around this particular contract, we would use the completed contract method. So let's walk through this short example together. Shanahan Construction Company has entered into a contract beginning January 1st, 2012 to build a parking complex. It's been estimated that the complex will cost $600,000. It will take 3 years to construct. The complex will be built for $900,000. So first, it asks us to compute the total gross profit estimated at the commencement of construction. Well, at the beginning of construction, we think we're going to charge them $900,000. We think it's going to cost us $600,000. So the answer to that question simply is 900,000 minus 600,000, or $300,000. Using the completed contract method of accounting for the gross profit, we would wait until the year 2014 when it's complete to book all the gross profit. So on our income statement, we'd have no gross profit in 2012, no gross profit in 2013, and then when we finally finish it, our actual costs turn out to be $610,000, by the way. So our answer would be in 2014 we would book our billings minus our costs, or $290,000. Now the problem with that, the complete contract method, is it's kind of misleading. It looks like we didn't make any money here, we didn't make any money here, and all of a sudden we made a bunch of money. The IRS in particular doesn't like the completed contract method. So another way to account for this kind of situation is the percentage of completion method. And the best way to measure percentage of completion is cost to cost. So let's look at 2012. In 2012, we incurred $270,000 worth of our costs, $270,000 of costs, out of a total of $600,000 that we think we're going to have to incur. We'll take that fraction and we'll multiply that times our estimated gross profit at that stage, which is $300,000. And so we're going to book $135,000 in 2012. We'll do the same thing in 2013. We've incurred $450,000 to date. We still think it's going to take us a total of $600,000. That's the $450 plus the $150. We'll multiply that times the gross profit we expect to make, and that gives us $225. But we've already recognized $135 before, so we have to subtract that out. So we're going to recognize $90,000 in that year. 2014 is super easy. $900,000 minus $610,000. That's our total gross profit, but we have to subtract out all the stuff we've already recognized. We recognized $135,000 in 2012, and we've recognized $90,000 in 2013. So in the percentage of completion method, using cost to measure our percentage of completion, we'll book $135,000 of gross profit in 2012, $90,000 worth of gross profit in 2013, and $65,000 worth of gross profit in 2014. And we're almost certainly going to be using the percentage of completion method for booking our gross profit. It's very rare that we'll ever use the completed contract method to account for our gross profit in a long-term contract situation.